Hi there. We are going to work problem 9-4A, depreciation by two methods, sale of fixed assets. So this problem involves using straight line and double declining balance and calculating the interest expense, then for each year calculating the accumulated depreciation, and then calculating the book value at the end of the year. So let's just get started on doing that. So it's asking us to do straight line and double declining balance, so let's do straight line first. I've set out a little table like they suggest with year, depreciation expense, accumulated depreciation and book value for each. Here's straight line, here's double declining balance, and I left some space for my calculations that I'm going to need. So to figure out the depreciation for straight line, we know it's the same amount every year, and it's pretty simple to do straight line, so let's do that first. So for straight line, I take my cost of acquisition, which is $800. I subtract the residual value, which is $90,000. So that equals $710. So right, that's what we're going to depreciate. That's the depreciable value, and we're going to divide that by the number of years, right? And so that tells us $142 per year. All right, so that's my straight line interest expense every single year. It's a straight line, the same amount. So let's just write the straight line depreciation expense for every year. Alright, now this problem also asks us for the accumulated depreciation. So, as you may recall, on the balance sheet when we write our assets down, we write the asset cost minus accumulated depreciation. So as interest accumulates year after year, we keep track of how much is accumulated as a total. So of course in our first year, we've only accumulated 142. Alright? So that's that. But in the second year, we've got 142 plus 142, or 284. Right? In the third year, it's 284 plus another 142 for 426. And we keep accumulating. 426 plus 142 is 568. And finally, 568 plus 142 should get us to our good old 710, or the total amount we're trying to depreciate. Alright, so there we are. The question also asks us to calculate book value at the end of the year. So that's what would go on the balance sheet, right? So if you're looking at assets on a classified balance sheet, you would look under property, plant, and equipment, and you would see the lithographic equipment, 800, minus accumulated depreciation, and then we would total that, and that would be the book value, right? The cost minus accumulated depreciation equals book value. So in the first year, we take that cost, 800,000, minus the 142, and our book value is 658. Right? Okay. So the next year we've accumulated 284 worth of depreciation. Still the same cost, 800. So it's still 800 minus accumulated depreciation. So 800 minus 284 is 516. Right? And that's what would go on the balance sheet. Next year we've accumulated 426. So 800 minus 426 is 374. Right? And the next year we do the same thing. 800 minus 568 is 232. And the final year we have accumulated our 710. 800 minus 710 is our residual value, or what we plan for it to be worth when we get rid of it. So there, we've done that. Depreciation expense in its straight line, accumulating it by adding that same amount every year, and the cost minus the accumulation each year equals that book value. Let's do the same thing for double declining balance. It's a little trickier. I gave us a little space down here to work because, as you'll recall, we're going to have different amounts for every year. We're just going to take double the declining rate and subtract it from the previous year's book value. Alright, so but it's not that hard. It's pretty easy to do. The first problem is, for double declining balance, we have to figure out, well, what's the rate? Well, double, right, is double the single rate. So if it's 5 years, the straight line depreciation rate would be 1 divided by 5, or 0.2, 20%. So we double that, and we got 40%. So for double declining balance, we're going to reduce the book value 40% each year until we get to the residual value. So that's how we're going to work that. So it's book value times 0.4 equals expense. So on year 1, if you'll recall, for double declining balance, we don't take out the residual value. So for year 1, the book value is 800 times 0.4 equals 320, right? Alright, so I'm just going to put that 320 up here in my depreciation expense for year 1, right? My accumulated depreciation is 320, right? There's nothing to add to it. We haven't had any yet. And book value is 800 minus 320, or 480. Alright, so there's our book value at the end of the year. Now, we need that for our next year's calculation. So we go 420 times, it's still 40%. 40% of 420 is 192. Right? So that's our depreciation expense for year 2. So depreciation expense for year 2, 192, 320 plus 192 is 512. Right? That's the accumulated depreciation. So 800 minus 512, right? 800,000, the cost, minus the accumulated depreciation of 512, leaves us with 288 as the book value. This 288 book value, we need that for the next year, right? Times 0.4, so 288 times 0.4 leaves us with 115.2 for our expense. Right, so that's the depreciation expense for year 3. 512 plus 15.2 is equal to is equal to 627.2. 627,200, right. Alright, so there's our accumulated depreciation. 800,000 minus 627,200 is 172.8. So there's our new book value, right? Book value comes back down here. Still times 40%. That'll never change. 172.8 times 0.4 is equal to 69,120. So expense for year 4 is 69,120. To accumulate it, you take your old accumulated plus your new expense. 627.2 plus 69,120 equals 696,320. Alright, so now to calculate your new book value, back to your cost, 800,000 minus 696,320 equals 103,680. Alright, now under double declining balance, this last bit of expense can be a little bit weird, right? Because we can't have our book value go below the residual value. So we know this needs to be 90,000, right? And we know that we're already down to 103,680. So what we're going to do is take 103,680 minus 90,000, and that will get us our depreciation expense. So this year is a little bit different from the rest because it's the last year and we're just trying to get to that number. So we're going to take our old book value, 103,680 minus 90,000, right? And that gives us 13,680 as our expense. Right? And we do that, this is just what we call a plug, because we just want to get to this 90,000. We don't care about the 40% anymore. This is the last year. We want our residual value to be 90,000, and we just plug that number. So whatever the book value is, we subtract out the residual value, and that's our depreciation in the final year under double declining balance. And of course the accumulated depreciation ends up being that same 710. And we did it. Alright, so it's not that bad. It's a little tricky to work through for the double declining balance, but I think you get the idea. The point is to get at the book value, right? So you need the accumulated depreciation, so you need the depreciation expense. Alright, this problem does have a little additional part, and it asks us to do some journal entries to record a sale. So we're supposed to assume that the equipment was sold for $135,000. Alright, so that's great. We need to know the accumulated depreciation, and we need to know if there's a gain or loss on the sale, and we need to record it. Alright, so let's just go ahead and journalize this. And then it asks us also to go ahead and record the entry, assuming the equipment was sold for $88,750 instead of $135. So we're going to practice a gain on the sale of something and a loss on the sale of something. Alright, so we were supposed to assume that they're using the double declining balance. Alright, so if I was giving you a problem like this, I would probably just tell you the depreciation. But it says the data presented, the double declining balance method was used, so that's going to tell us what accumulated depreciation we need to use for our calculations, right? Because we have to figure out, well, was there a gain or was there a sale? Well, at the point that we sold it, what was the actual book value, right? So we need to figure out that difference. Right? So if you look at the problem, saying we're selling it for $135, right? So that means we're getting cash of $135 in, and the accumulated depreciation at the time, right, at the time was $696. It's telling us they sold it to us in the first week of year 5. So the first week of year 5, right, we haven't taken this depreciation yet, right? So here's the book value, 103,680, right? And here's the accumulated depreciation, 696,320. All right. So in order to do this little calculation, right, to know what the loss or the gain was, we have to take that 135 that they're paying us in cash minus 103,680 that we have it on the books for, and we get a gain of 31,320. So you just take the book value, whatever it is, the difference between the book value and the cash, and that's either your gain or your loss. In this case, because they're paying us more than the book value, it's a gain, right? So we just need to record the cash, right? We need to eliminate the accumulated depreciation account, we need to eliminate the equipment account, and we need to recognize this gain. Alright, so when you have a sale of equipment with a gain, right, I always like to start with cash, right, because we know we're getting cash in of 135. Alright, so that's easy peasy. We also know that getting rid of the accumulated depreciation is our other debit, right, because Typically, accumulated depreciation, being a contra asset, carries a credit balance, so to zero it out, we need to debit it. Accumulated depreciation, equipment. So we're selling it at the beginning of the 5th year, not the end. So the end of the 4th year is the accumulated depreciation, $696,320. All right. Now our credits are the equipment, right? Because we've got the equipment on the books for $800,000. Right, so we have to get rid of that. Right? And our gain on sale, right, is that $31,320. And you can see our debits equal our credits. So I guess we did that right. Now let's do it again at a loss, right? So assume the equipment was sold for a loss. All right? So remember, it's the beginning of year 5, so the accumulated depreciation amount is the end of year 4. We still have this book value of $103,680, but now they're only giving us $88,750, right? So we're going to take the difference between $103,680 minus $88,750, and that difference is $14,930. So that's our loss. This one was a gain because they gave us more. This one is a loss because they gave us less. Here's our book value, right? So, same idea, right? Except this case it's a loss, so it needs to come over here on this side and be a debit. All right? So we still have cash. And in this case, the cash is $88,750. All right. We still have our accumulated depreciation. And I always put what it is, because a lot of times there's more than one depreciation account. All right, $696,320. Then we have loss on the sale, right, of $14,930, right, and our equipment, which is still $800. And you see how these all add up to be $800. That's it. Pretty simple. The math is very simple. You can definitely do this. Practice it a few different times before we get to the exam. Okay, good luck.